Hello and welcome to Trading the Trend. My name is James Boyd. Today's date, October 9th. We welcome you here today. We'd like to welcome Kevin, Will, Josh, Gary, Robert, Grace, Dom, and many others. Welcome to all. Now, just real quick, if you have questions, things that you would like to discuss, go ahead and actually type that in. We like to kind of throw those out there and mingle some of those questions in with some of the material that we'll actually cover here today. Might kind of be something similar to what I have planned. And but just know that your questions, type them in the chat, and we'll see if we can answer those as we go, especially as we go over some of the content. Now, just real quick, you can find me on X. My handle is @JamesBoydCS, so check that out. Also, remember, when we talk about examples, we'll talk about stocks and options. Remember that options carry a high level of risk, not suitable for all investors. Understand that there's different option strategies, and be aware of what those rewards and risks are for each of those strategies that you might consider. When we talk about examples, we remember that I'm going to talk about things from an informational purpose only. Should not be considered individualized recommendations. You get to decide what you want to invest in if you want to invest. Also, remember, we will be using the Paper Money software application for educational purposes. Remember that also investing has risk, including loss of principal. And also, when we talk about short options, those can be assigned at up to, they can be assigned at any time up to expiration, regardless of the in-the-money amount. Those are called American-style options, and those are the ones that we're showing examples of. Now, today we'll talk about kind of some of the things we're seeing in prices, whether it's gold, the U.S. dollar. We've got some moves actually happening in that space. We pulled up the U.S. dollar yesterday. We're going to kind of see, are we starting to kind of get that correlation again on the dollar versus commodities? Now, not all commodities, as we'll see in just a sec, but I want to actually bring up the U.S. dollar right off the bat. Second, we're going to also talk about maybe how that's affecting kind of the larger caps per se. We'll talk about the cash indexes, NASDAQ, SPX, RUT. All indexes are not the same right now. And then we're going to kind of talk about where's the money going, okay? Japan actually hit another new high here today with the yen actually falling. And again, our goal is we're trying to find those trends. And the question you want to ask yourself is, what trends are you riding? Now, in our examples, we'll take a look at past trades, and we're going to look at new examples as well. When we talk about past trade examples, I want to kind of talk about maybe entering protection after the investor already owns the stock already. I want to kind of talk about maybe some covered calls, some callers, why an investor might actually put those on based upon what we're seeing. Now, let's go ahead and actually just take a quick look. And I'm going to start with just, since we're here, let's take a look at it, okay? So we got gold, right? Now, don't feel bad for the gold investors, okay? Gold has, the price of gold for December actually went up to 4,081. The RSI, as I posted on X yesterday, was at 91. I think that was the highest reading we've ever actually had on gold, okay? Now, again, don't feel bad for gold investors because there's probably been some potential unrealized gains there. But it is actually taking out yesterday's low, not taking out the previous day's low. When you get stocks like this that go vertical, or I should say prices like this that go vertical, you might want to consider maybe even setting stops underneath intraday lows, okay? So like if I said, where's the intraday low here? Well, it'd be at 4,006. Where's the intraday low here? 3,965. And they might set those stops underneath the intraday lows. Now, obviously, if you said, I'm going to take it from the highest point, it was yesterday, second highest point, third highest point, fourth highest point, and so on. The farther you get back, the more you're trying to trade the flag. Now, I want to pull this up when you look at the U.S. dollar, something that we made mention. We have not had the U.S. dollar go up that much. The U.S. dollar has actually been pushing back to the upside, and you got to kind of think about correlation, right? When you back this chart off and actually take a look at kind of what's been happening this year, this is 2025. The U.S. dollar was way up here. And if that as the U.S. dollar actually fell, and it fell in a large amount, you might say, well, what does this have to do with anything? The answer is a lot. And if we take a look at the U.S. dollar, the basket fell 12%. Now, we don't have to necessarily be the sharpest knife in the drawer, okay? We just don't. But we know that there's correlation, right? If one goes down, The other one could actually go up, etc. Okay. Now, what you're now going to notice is if you look at the US dollar trying to go back to the upside, could some of these rallies in gold, in silver, etc., be pushed down? Now, is it straight across the board? No. If you pull it up just real quick, silver, you are going to see that is pushing down as well. This is why you want to keep an eye on the US dollar. The other thing you would keep an eye on, if you look at copper, copper is not necessarily pressuring down. It didn't go up as much as gold and silver, but you are actually seeing, let's say, copper kind of fading back off the high. So I think there's a warning here in the US dollar rallying. By the way, this is where it gets really interesting, because what is the way you could actually trade the US dollar strength? Well, the US dollar strength could actually be other currency weaknesses. Tomorrow, Kevin and I will actually talk about even ETFs that, for example, what could be trades if you're expecting the US dollar to go up? If one goes up, what is the other side of the trade that potentially might go down? This is where it gets interesting, okay? So that's what I want to kind of first off is some big moves actually in the US dollar. Now, when we actually talk about the US dollar, we're talking about multinational companies that don't just sell here in the US, but they sell abroad. As our currency goes up, it makes our products more expensive for the Europeans, the Brits, the Aussies, the Canadians, and so on. And what you're now going to notice is kind of trading a little correlation there. You're actually seeing a little push down in the Dow. Now, not everything, and this is where you have to kind of look at the individual setup here, okay? Not all things in the Dow are going down, but I'm going to say this: there's quite a few stocks in the Dow that they have been down, and they're just kind of going down a little bit more. Now, stocks like NVIDIA, okay, if you pull up NVIDIA, that was a brand new high here today. Many technicians were looking for that. You did see a little Johnson & Johnson, or I should say Big Johnson, hit a brand new high here today. And you look at UNH, that was up higher, but it did go up to the shorter term target area at about 377. Probably the biggest takeaway from Dow, you're seeing Boeing get pushed down. Boeing got inside the channel, got pushed down pretty aggressively here today. Now remember, the more you get the index to drop, the greater the chance that the components of the Dow drop as well, okay? If we take a look at what else was kind of a little surprise, you're going to see that little Apple does not look extremely healthy right here, okay? We're actually seeing almost a shorter-term lower low. So this is where we kind of have to say, like, hey, whoa, what are the exits here, okay? When we also pull up Microsoft, that was actually one we've been watching that had a higher low yesterday. That was not a follow-through here today. It actually did not gap to the upside. Matter of fact, gap to the downside, and now right back to where this old breakout was. So the moral of the story that we've actually seen so far is there could be some stops, some stop adjustments, some entry of protection that the investor might consider based upon what we're seeing. Now, are there any questions with that? Thank you, Connie, for answering that question in the chat. So first off, now Connie makes mention of Connie used to teach the ETF class on Monday, which she did a great job. I was the chat person. I'd sit back and enjoy myself. She did a great job with that. Had a nice portfolio as well. The biggest actually thing is that ETF class that Connie used to teach. Kevin and I are going to continue to teach that Friday morning, 9:30 a.m. Eastern. That is not recorded, so feel free to join us. So many of the things that Connie talked about on Monday, we'll try to also include on Friday morning, okay? Now, I want to kind of pull up just real quick. Will, I agree with you there, okay? Agree. Now, what I'm going to do is I'm going to kind of pull up, let's say, the portfolio for just a sec. Now, by the way, is it all the same? Well, when you actually pull up, let's say, the SPX, and let's pull this up for just a sec. SPX. If you look at the SPX, what you're going to notice is what type of candle is this? Well, that's like a bearish engulfing candle. By the way, so is that, okay? So there's kind of been some profit taking over the last 2 out of 3 days. When we look at, let's say, quickly the NASDAQ, you're going to kind of see, is it a bearish engulfing? No, it doesn't look the same. Little selling, okay? So we're going to kind of say there's some pockets of still that are holding up, but there are some ones that are dropping, okay? Now, what I want to do is I want to kind of bring up the paper money portfolio, And what I want to kind of show is, let's start with stocks first, okay? So if I look down at this portfolio, Microsoft, NVIDIA, PSX, the one that kind of is standing out to me a little bit is the one that really has trend number one. This is the one that's kind of showing that, hey, we're not just down a little, we're not at an area of resistance. We're not, for example, let's say just falling down below the 10-period moving average. This is one where the price is below both moving averages. This is the trade that has the greatest chance of getting stopped out. The question we want to ask ourselves is there a stop? We can't say that, hey, I'm bad with exits, and I don't even have a stop. Well, let's go back and let's just make sure we're kind of being diligent. If we go back and look at Phillips 66, let's pull up the chart and kind of ask ourselves is there a stop? Well, now we can see where the stop is, and the stop is sitting here right at 127.49. So if we go down about another $3.50, that is going to stop out. We go back the last couple days. What do we actually see on there? We've had a red line on the moving average for a couple days now, and it's what you'd expect. Price below the 10-period moving average, and it's just bleeding down, okay? Now, this is why I kind of said price down below the 10-period moving average is not fun if you have the position, okay? It's just giving back unrealized profits and or starting to kind of eat into that capital. Now, if you take a look at this, we're kind of right below that line. Now, we might say, well, could we do something here? The thing is, we already have 50 shares. It's already about what it could fully invest anyway. I can't buy another 50 shares, protect it that way. Could we actually maybe do a short call, vertical on it, something like that? You know, I feel like we're almost so close to the stop. Going to see if this trade just goes through, if the stock goes through the floor. If we were looking at this maybe 3-4 days ago, we might have said, hey, could it drop even more? There might be more room, but kind of right now, we're kind of so close to the support level. Not trying to put on a bearish trade or protection at the support level per se in this one, especially when we don't have 100 shares and we're so close to the support area / stop. Now, so Phillips 66 we looked at, we're under pressure. The one that I do want to take a quick look at, which is also showing trend number 5. Now remember, trend number 5 is really kind of showing you that we're losing momentum. Price is now faltering and getting down below the 10-period moving average. So in this case, if you look at Uber, there's 100 shares. Hallelujah. Okay, not everything can have 100, but boy, it's nice. It kind of gives us some potential options. Now, the other thing we actually noticed that's not great is the 20-period moving average went red, and it went red a day ago. Okay, now let's pull this up, and what I'm now going to do is if I pull up Uber, we now actually see that the stock is right here. Now, how many of you would feel like, hey, there's a pretty good level of resistance? How many of you would actually say in the last 3 days, the stock doesn't seem to want to go above 100? Would you say that's fair? We went to 100 there, sold down pretty aggressively the next day, tried to bounce up again, gapped up. That was pretty much the high, sold off again. Now, the stop, if you look at this, is down here. We could probably move that up. But this is where the investor says, look, it's consolidating. And instead of being so sensitive to direction, maybe we could kind of alter the direction. Now, this is where the investor says, look, I got 100 shares. Could I sell a call up here? I'll put SC. And could I maybe buy a put down here? Okay, LP down here. And so if you do that, you're kind of thinking that it might consolidate. Okay, now we can't say it's downtrending, but it definitely is chopping around. Okay, now the investors probably trading Uber because they want to be bullish Uber, but just right now the trend is not really agreeing with that right now. Now, why not just get out? If you get out of everything that goes sideways or goes down, everything, you're going to have a hard time actually putting the positions back on when they go back up or if they go back up. So how does an investor, and what I'm going to do is I'm going to cancel the stop. We don't really need a stop and a long put per se. I'll tell you why. We're now going to go to the trade tab And what we're going to do is on the trade tab, we're going to type in Uber. Okay. Now, what I want to do is in this is I want to bring this up is we have 200 shares. I'm showing 100 in this position. So we're going to hold with that. Okay. We're going to go to the trade tab. And what we're going to do is we're going to go look and see which call is above us. Now, if we were a little bit more pessimistic and said, hey, James, I actually think the price could pull back, you might sell like an at the money call. You wouldn't sell the at the money call unless you were kind of pessimistic and actually thought the price could pull back. Now, we could actually sell the 100, which also has a delta of 47, or what we could do in this case is we could even sell, let's say, the 105. Usually the 105 is going to be the one we're going to look at that actually has a delta between 30 and 40. That delta is just telling us the probability of the stock closing 1 penny above the strike. Okay, that's one way to look at it. It's also the change in the option price over the change in the stock price, $1. Now, if we take a look at this, do we have to do the Novembers? Well, let's see if we can't have a little mixture, okay? Wonder if you said, look, I like the idea, but I don't want to go out so far. Okay, fine. Let's show a little variation. Maybe we look at weekly options. That's fine to look at those, but we want to make sure there's liquidity. The ultimate sign of liquidity is what's the bid-ask spread, okay? Now, we started at the money on the calls on the put side, and they're really 15 cents, 10 cents. Second thing we actually look at is open interest. We like to see in a couple hundreds or higher, and we like to obviously see volume for the day. Now, obviously, if we're 1 minute into the market, not going to probably see a lot of volume, but it's actually not as bad as we probably would have thought. Now, what I'm going to do is I'm going to go down and look to sell. Let's say I'm going to try to sell the 101 strike. Now, how do you do this if you already own the shares? What we're going to do is we're going to right click on that bid. Then we're going to go to sell, and we're now going to go to where it says call or synthetic. If we do that, okay, we're now saying, look, we're going to sell the 101 call, okay, and that is the obligation to sell those shares from now until expiration, okay, not just an expiration. Now, if the stock is at 96-ish and we agree to sell for 101, there's some upside gain there. Noted. Now, what you're now going to see is the put, okay? And if we go look at the put and we buy a put with a delta between 30 and 40, it's really going to be, let's say, the 94. Now, the put that we're buying is the right to sell the shares, okay? And whose right is it? The investors, the person who's buying it. And that right could be exercised prior to the expiration, not just at expiration. So why would they want to exercise it? Well, number one, they probably want to get rid of the shares. Because if you exercise the right to sell 100 shares of stock, you're saying, I don't want to be in the stock anymore. And that probably means the stock is below 94 at and or near expiration. So why do people buy the put? They're trying to define the risk, okay? Now, when you look at if you look at the selling the 101 call, that is a bearish single option. If you buy the 94 put, that's a bearish single option position. When you combine those two together with shares, that is a caller. Now, if we take a look at this and said, what is the net debit to do this? Answer, 13 cents or $13. That does not include the commission. That would be $1.30. So what someone is trying to do, if they enter into a caller, they're really saying, look, my prospect, for what I think it's going to do, I think it's going to go neutral. I think it actually could pull back. And what they're trying to do is reduce the directional sensitivity if that stock were going to go down, and they just try to limit their losses. Have you ever been in a situation where you said, I don't like where this position is, and I think the position is at risk of declining some? I don't know how much, but I don't like what the market is doing. I don't like what the sector is doing. I want to hold on to the position to see if it can, but I just want to protect it. That's what this is. Now, what I'm going to do is I'm going to put in the stock section, send the order. Now, notice if this gets filled, it's going to sit right there. Now, the biggest thing that we need to understand now is when you take a look at this right here, delta, okay, delta. If this position goes on, sell the call, buy the put, etc., we're expecting overall the delta to probably be like maybe 35 or so. What does that tell us? Well, if the stock goes down $1, down 35. Stock goes down $2, 70. Stock goes down $3, about 105. Stock goes down $4, about 140, and so on and so on and so on and so on. Now, the bad part, what's the bad part? Well, if the stock actually goes up $1, instead of being up 100, we're only up 35. Why? Well, because the bearish options are dragging on this stock position. Stock goes up $2 instead of being up $200, we're up $70. Now, the $1 million question gets asked here. Well, where would you get out? Well, you want to kind of go back to if you have bearish option positions. Listen to kind of the phrase here. A bearish exit is a bullish entry. Well, what is a bullish entry? Well, it could be a bounce off support, or it could be a breakout itself. Okay, well, let's go back and kind of do this. Well, if we go back and say, well, where is resistance? Where would you say it's no longer bearish and it could be heading to the upside? Well, you might say, James, well, duh. Okay, hey, don't say duh to me. Maybe the stock finally gets above 101. If we can get this filled, could we set, hey, if this order goes above if the stock goes above 102 and change, buy the protection back and just have the shares? Yes. Okay. And that's what we're going to do if we can get filled. Okay. And so so first off, I've said this for years is why don't people buy puts? And I was the funniest answer to that question. Okay. I kind of tell a story. I was talking to a couple and I asked the person, why don't you buy puts? And the wife chimed in and says, he's cheap. Now, it's still funny to this day because they were such a funny couple. They were a sharp couple, okay? They really were. Now, here's the thing. The biggest actually thing is when you talk about, let's say, a position. So when we go back to Uber, let's put it back up top, okay? I want to see, it hasn't filled yet. So I even kind of moved the order and we're going to see if that position fills, okay? Now, when that position fills, if it does, we're going to set a buyback and we're going to say if it gets at or above, let's say 102.5, buy or exit the option positions. If you get rid of the option positions, the only thing you'd really have left is the shares. Okay? Now, here's the deal. We kind of have to think about this for just a second. Let's say we bought 100 shares, okay? 100 shares at $100, okay? So what you really got, you got to think through what you're doing, okay? It's a $10,000 investment, $10,000. So how much does what does the collar really cost? The collar costed $13 if we can get filled there, plus a commission. So we said, well, what does it cost? Answer, it costed $14.30. Now, are you saying per share or is it literally $14.30? The answer is $14.30. What does it also cost? It's the opportunity cost of the stock going higher than the strike price of 101. However, if you said, well, James, I bought those shares at 96 and it goes up to 101, do the math. That's $5, okay? So really, and then if you said, well, what's the cost? It's a debit of 13 cents. Your upside is capped. You'd have a $5 gain on the stock, but you spent 13 cents. And so really you'd be up $487 on the position if someone took those shares from you at 101. Now, I don't know, you can call it what it is, but if someone's not willing to kind of maybe put that collar on for 13 cents per share or $13 for 100 for a grand total of $14, so the explicit cost is $14.30. The opportunity cost is if the price gets above 101 and let's say, or someone takes the shares prior to expiration, if that actually happens, in this case is they cap out at $487. So I think sometimes when people don't want to spend money, you got to ask yourself, what type of investment are you really talking about? It's a $10,000 investment. It's not a small investment. Okay. Now, the biggest thing is if the stock went down, run the numbers and see how much you would be down. If it went down, you're trying to really protect the capital. Okay. Yep. It all comes back to economics, doesn't it? Okay. Now, other questions. Okay. Now, the Chris B says, what is the benefit of setting an exit using a stock price versus percentage of the option price as an exit? So the biggest actually thing is you can get, and we went over this before, but I'll kind of just re-mention this. Now, I want to go back to just real quick. So we know that, like, if you said, hey, I'm going to get it, let me take a position. And the position that I'm going to look at here, just really quick, let's say we actually said, look, I want to do a bullish position, let's say, and I'm going to look at a couple stocks just real quick. Let's say we said, you know what, I want to get in a position like Netflix. Now, let's say we actually said, we want to get in a position like Netflix that's going over earnings. Okay, we're trying to do this on purpose. Now, let's say you actually said, look, I want to get out if we go at or below 12.20. Okay, so the price has to just go at or below 12.20. It's just straightforward, okay? You go at or below 12.20 and it could trigger to sell at 12.20 and or lower. Now, the problem is if we actually did an option trade, we know that the options are influenced by the price moving up and down. We know that it's affected by time decay, but the biggest thing it's probably influenced by behind price is volatility, okay? The fourth thing that we would also include in there is liquidity. So here's the reason why I don't show setting exits on percentages of option prices. If all of a sudden the volume just drops, all of a sudden it just drops. All of a sudden the bid is going to go far down, the ask is going to go far to the upside, and then you set a stop based on a percentage of the option price, and you got caught in the liquidity trap. Okay, and that happens. The second thing that actually, we've seen that many times. The other thing is, wonder if volatility changes quite a bit. Maybe there's some news about Uber that, hey, they're in court or they got sued or whatever, hypothetically it was, and now it's moving. Now there's some speculation, maybe a takeover or whatever, and all of a sudden now, if we actually said, let's go to Theo Price, and let's just say the options move by just, let's say, 5%. Well, if the options move by 5%, all of a sudden the option that was at 565 goes to, let's say, 611. Or if we said, well, wonder if volatility went down. Well, all of a sudden it goes down 10% and the stock did not move at all. The volatility just moved, okay? So, you're kind of getting caught on the volatility fluctuation, which can happen a lot, or going up to leading into earnings, on earnings, or right after earnings. And the second one is liquidity. We know liquidity is not the same throughout the day. It's like going to the store, grocery store. There's sometimes more people at certain times of the day. When there's not hardly anyone there, bid-ask spreads widen out, okay? When there's more people during the day that are trading, the bid-ask spreads narrow. So some people don't like getting caught in that. And they just say, look, I'm going to make the exit based off a stock price, okay? Now, I know I'm going to bring up Netflix as far as the next trade, but it didn't matter if we actually had Uber, okay? Because it would be the same, okay? Now, let's do the trade example on Netflix. We just kind of spoke a little bit to volatility. Now, that's the kind of interesting thing is some people try to trade direction. Some people are just trying to do time. One way to try to do time decay is dividends. We know dividends are not guaranteed indefinitely, right? They could raise them, cut them, all the above. Now, the biggest actually thing is, the other way is volatility, okay? Or the combination of all three, okay? Now, what I'm going to do in this case, if we go back to the 3-year weekly, what I'm going to do is I'm going to kind of say, look, let's kind of speculate, okay? Could Netflix go to the upside? Now, we can look on the bottom and say there's a little divergence on the bottom. Okay, sure. But the biggest thing we're really kind of watching is the 21st, which comes up in 12 days. Now, what I'm going to do is I'm going to tack on here the implied volatility. And that implied volatility, if I pull this up, this is just going to show volatility over time as an oscillator, if you will. And now if we look at this, we can kind of see where are we in that range. Well, you know, if we look at the low, we were kind of right around 20 for a long time. Where were we when it was high over the last year? About 50. Where were we at the highest point? About 65 or so. Where are we? We're kind of right in the middle or closer to the high. Now, if we take a look at this, what I'm going to do is I'm going to go back to, let's say, now when the implied volatility is higher, what that really does is, now, by the way, when we pull up charts, one thing that we could do is just kind of make sure when we go back to the trade tab, we want to make sure that that hit the kind of the chain there, go red. So when we pull up a stock on the chart and I go back to the trade, it's going to match what the chart is showing. Okay, now, what I'm going to do is we're going to try to use that volatility. What do you mean use the volatility? Well, the higher the volatility, the higher the premiums. Now, what I'm going to do is the higher the volatility, the bigger the premiums. We might say, look, we normally might look for a strike with the delta between 30 to 40, but if the volatility is higher, the investor might say, look, I might be able to go down to a lower strike price and still get some decent premiums. Now, the way we could kind of look at this and kind of say, well, when you say that, like what metric are we really looking at? ROR. I like to think of this like it's the option premium divided by the stock price. Now, it's not exactly, okay, but it kind of just gives us a general percentage. Again, option price divided by the stock price. Now, some investors say the cutoff for them might be, James, I can't do it unless I get 1.5%. Now, this is assuming that there's more than 20 days to expiration. So some investors might look right in the ballpark between, let's say, the 1125, maybe up to, let's say, the 1150. Why the lower delta? Well, they're choosing the lower delta in this case because they want to have a greater chance of being right, okay? 25% chance to be below, 75% chance to be above, and you're also trying to kind of factor in that the stock could be more volatile. Now, in this case, we're also going to look and see where's the liquidity. Well, that liquidity is kind of right around the 1140 and the 1135. Look at the open interest. So in our example, what we're going to do is we're going to right-click on the 1140, okay? And now what we're going to do is we're going to sell, and we're going to go to vertical, okay? Now, when you sell this vertical, if I did the 1140, okay, and let's say we buy, let's say the 1130, and I don't really want to do that. I want to kind of stay where there's more liquidity. If I actually looked at this, and by the way, these are wide, at least what it's showing me in the paper money account. The wider the spreads are here, it's kind of make it where it's harder to get in and out on an intraday basis, unless those narrow. I'm in a paper money account, so I don't know how actual that is in a real, okay? Feel free to check me. Now, what I'm now going to do is if we look at this, 85 cents. Now, that's $85 a contract. That's going to be, in this case, $415 worth of risk. When we actually look at the 85 cents divided by 415, it's really going to give us a 20% ROR. For many, that might be the floor. Why is it not as high as usual? Answer, we're picking a lower delta to start with. Now, when might there be reasons to do that? On earnings, okay? Why is someone going down there? They're trying to account for the earnings. Why are they going down there? Because the implied volatility is higher. Why are they going down there? Because the premiums are bigger. If the premium is bigger, it gives us a lower break even, 1139.15, which is kind of interesting considering that is about a 100-point drop in the stock, and it could still be at break even. Now, we would never wash our mouth out with soap. We would never say there's no way it could drop down there. Never say that. There's time left, it can happen. Now, the biggest thing is what we're going to do is we're going to send the order. Now, I'm going to tell you right now, there's a lot of investors, they like these strategies where you're doing kind of 20 delta type strategies, okay? We say 20 delta type strategies, we're just saying higher probability type trades, okay? Now, the comment is, why the weeklies? Well, I'm trying to kind of mix it up. So there's been some questions upon, hey, a lot of the examples you look at, they're monthly options. Can we show some examples of, let's say, weeklies? Okay. Now, so I'm kind of trying to address that. If you said, well, I like the monthly options because I tend to see a higher amount of open interest, I agree with you. However, what I like or what someone else likes is not maybe what someone else likes, okay? So I'm trying to show a little variation. If you said, nah, I'm going to really go to the 1140 for the monthly option and then maybe buy the 1135. Now, I know this might kind of, blow your mind, but I ran into people over the years where they trade things that really aren't that liquid. It always blows my mind, but a lot of us like liquidity, okay? If we were to, the tighter the bid-ask spread is, it gives us a greater chance to get in and out of the position where we're not, getting hurt as much or disadvantaged by the spread, okay? Now, all right, any other questions there? So that's why we're kind of showing some of the weeklies and the monthlies here today. Now, let's also go back to other stocks that we might kind of keep an eye on. So if I were to go back just real quick to, if I go back to, let's say, CEG, we know that when we looked at CEG is the utility area. It's kind of labeled as the energy, but that's one that's actually been having a pretty strong up move as well. The CZS for Zscaler, that kind of looks like kind of your classic cup that is setting up as well. Now, there's been some questions that have been asked, like, well, James, could you show a bearish trade? I mean, not everything's bullish, okay? Well, let's kind of just real quick go to one, and let's say the investor said, you know what, James, I want to do a bearish trade. And I want to do a trade where I don't think the price can go above the area of resistance, okay? Now, I know that not all of us feel the same. In other words, if we go up to resistance, some of us are thinking a continuation pattern, and some of you are thinking, yeah, right. I think this is the brick wall, and we're going to fall down. Now, the thing is, you got to remember is if you put on a bearish trade here, you're really thinking that the price is going to stay below 36.44, okay? Now, what I'm going to do is we're going to make this a bearish option trade. We know that if we did a bearish option trade, you could do like a long put where you think the stock is going to go down below the strike price. The options become more valuable. Second, you could actually do like a short call vertical. It's like a covered call, but you don't have the shares. You have upside protection. You could do a long put vertical, okay? Long put with a credit to offset the debit, changes the break even and the option Greeks a little bit. You could do a short call vertical and a long put vertical. That's known as really like a caller, but you don't have the shares. Now, I want to go there for just a quick second. And what I'm going to do in this case is let's go to the trade tab for just a sec. So we all know really about a short call spread. That is not like, oh my gosh, that's unbelievable. Well, what I'm going to do in this case is if I right click, now we're going to choose the monthly option and we're going to go to sell and we're going to go to vertical. And the purpose of the short call vertical is to get a credit, okay? We're trying to say, look, we're going to sell a call where the investor thinks the stock could stay below the strike, okay? If it does at expiration, the investor actually has 50 cents or $50 per contract. Now, wonder if they wanted to come over here to, let's say, the put side and use that credit to help pay for the put, okay? Single order, first triggers SEQ. We're going to come over here and buy the put. Now, if you look at that, what's the bid? 60 cents. What's the ask? 75 cents. Let's just say we're willing to get filled at, let's say, 70 cents. So how much is it going to cost? Answer, well, you pay 70 cents. You collect back 50 cents. It's going to cost $20, okay, to enter the position. Now, when we say $20, you're talking about $2,000. You're talking about literally $20. The answer, $20, okay? Now, if we take a look at this trade, what you're now going to see is, let's kind of show what it looks like on the Analyze tab. Okay, this is where it gets fun. Now, if I take a look at this and said, okay, what does this look like? Baby step, let's go kind of through this nice and easy. When we look at this, what you're now going to look at, this is your classic short call vertical. Why is the diagram backwards? I'll tell you why the diagram's backwards. Because the stock, this position, the short call vertical, benefits if the stock were to decline. Okay? So if that stock goes to the left, the profit loss goes up, and it goes up to a point and it's capped. And that blue line is capped because that is the credit. Okay? Now, that's great to a point, but wonder if the stock really goes down. Okay? Well, that's where that long put comes in. Instead of being capped and having a sad face, because if you really get that stock to drop, how do you get a bigger potential upside? La la! This is where that long put comes in. Why don't people buy the puts? Well, in the words of that person, hey, they're the person he wasn't cheap. Okay, I don't think maybe that was completely true. The biggest actually thing is if you take a look at this, instead of actually having a capped upside, the long put makes it so if the stock goes further to the downside, to the left, the profit loss diagram is not capped at 50 bucks. It goes higher and higher and higher, but it is capped if the stock goes to zero. So there's a limit, but it has a lot bigger upside potential, but it is capped if the stock goes to zero. It can't go -1, -2. Now, I don't know about you, but a lot of people kind of like that. So why don't people actually buy the long puts? They might say, well, is there any way I could kind of have something to offset? And the answer is, yeah, short call vertical. So if we did this trade by itself, this trade is based upon, can the stock stay below the resistance? Now, just real quick in the chat, how many of you are thinking that some of these stocks might drop? Anybody? Now, I'm going to tell you right now, there's time. If you ask me what is a strategy that you would want to know like the back of your hand, okay? If you said, I don't know what a short synthetic is, which we just did, that would be hard, okay? The problem is when things go down, a short call vertical, I mean, it's nice, but it's only nice to a point because it's a cap gain. The long put, when things go down, a lot of times those long puts, they're expensive. And the more expensive they are, the lower the stock needs to drop to break even. That's the truth. Now, you got to think about this short synthetic, if you will. This is really a caller, just without the shares. But it has capped losses. Now, when we go back to that just real quick, what you're going to see is, how do we know it's capped? Well, wonder if the stock goes up. Wonder if Warren Buffett comes in and buys the company out for $50 a share. Notice the blue line goes flat, and you're going to see that it can only get so bad, okay? So there's a built-in maximum loss, and that's another thing that kind of causes some investors not to want to be bearish, because wonder if the stock goes up. Well, it can only get so bad. That's kind of nice, okay? Now, let's put this trade in. I got to wrap up here. We're going to go confirm and send. So your homework assignment is, can you find 1, 2, or 3 stocks? Can you practice, not can you will, do 2 to 3 trades on some stocks that are showing maybe a resistance and or downward trending. Sell a call vertical and buy a put with it. And I want you to just do 2 or 3 of them and kind of see how the prices move and how does it relate to the options. Now, I'm out of my time here. We're going to go ahead and send that, but there's been some questions on, can we start to talk again about some bearish strategies? And this is really one that kind of, I think a lot of investors need to know that really maybe has some advantages compared to other strategies that are bearish. Now, we got coming up next, quick reminder that if you went right to, let's say, let's go to Learn. We're going to go right to where it says Schwab Coaching. You're now going to see if we went to live webcasts and virtual workshops. Scroll down. Coming up next, We got short verticals, Cameron May. We also got ThinkScript studies, Brent Morse. And we also got selecting an option strategy, speak of the redhead, Connie Hill. Okay, so check out these classes coming up. I'll be back on tomorrow morning with Kevin, bright and early. That is live only. So join us there as well. So those are the next couple classes you can join as well. So just real quick as we get going here, remember with what we discussed here today was done for example, illustrative purposes only. Gave you a homework assignment. Go out and practice it, okay? And I think that's going to help us not only with just bullish stocks in general, but also if you just want to practice trading bearish strategies. Thanks so much. Stay tuned for our next webcast coming up next. And don't forget to subscribe and put the thumbs up on the video. Take care. Goodbye.